Welcome to Deloitte's Debriefs Tax webcast series in Asia Pacific. Our webcast today is from our Financial Services Industry Series and is titled Tax Policy Developments and Reform in Asia Pacific. My name is Michael Velton and I'm a financial services tax partner based in Deloitte, Singapore. I have four speakers with me today, Senturan Alalingam, Junwei Han, Matthew Lovett and Terence Tan. Sen is an indirect tax and tax technology partner based in Deloitte, Malaysia. Han is a senior tax manager based in Deloitte, Singapore. Matthew is a tax director based in Deloitte, Singapore. And Terence is a tax partner based in Deloitte, Australia. You may access our bios on the left-hand side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey questions on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking Request CPE icon at the bottom of the webcast console. In terms of the agenda for today, our focus is the overall tax policy environment in Asia Pacific, insofar as it impacts financial services. And within that, we'll have a specific focus on developments related to digital assets and digital services. So the topics we're going to discuss today are, recapping on some of the broader themes in financial services tax, the draft Pillar 1 exclusion for regulated financial services, proposed CRS amendments and crypto asset reporting framework, or the CARF, more broadly looking at technology trends and market developments in financial services, indirect tax and remote services, digitization of indirect taxes, and finally, we'll take your questions and answers. Next slide, please. In terms of the themes in financial services tax, the slide that is on the screen really tries to capture various of the recent developments and sort of put a sort of framework around those. And when you look at them, sort of a couple of things kind of immediately sort of come out. I mean, a lot of the tax policy response that we've seen over the past year or two, not surprisingly, has been in response to COVID-19. The need to build more resilient tax systems, the need for new revenue, be that new taxes or increased tax rates. And Singapore is a great example of what we've seen, increase in the rate of GST, increased rate of property tax, carbon tax, personal tax, etc. So that's obviously kind of a key theme that's driving tax developments, tax policy developments. At the same time, broader international tax developments continue. BEPS 2.0, Pillar 1, Pillar 2, most jurisdictions are members of the inclusive framework. And for instance, we've seen already the announcement by Hong Kong and Singapore that they'll implement domestic minimum taxes. But the focus just hasn't been around sort of, new taxes. I mean, we've seen a real focus in terms of administration and compliance. And within that sort of different dimensions, increase in terms of, taxpayer services, ensuring enhanced compliance, further digitalization of taxpayer services. And, that is something that, we expect will continue. In that sort of, broadly in that same range, that same vein, seeing an increased focus on the flip side on digital taxes and how best to tax, digital transactions, digital services, digital and crypto-related assets. And that's obviously going to be a key theme of what we focus on today, is really sort of looking to go deeper in terms of some of those developments. But before we do that, we thought we would start first with just an update around Pillar 1 and the exemption of the regulated financial services exclusion under Amount A. In terms of that, Han, can I bring you in to sort of provide an update on the consultation and where we stand with the exclusion for regulated financial services?
Yeah, sure. Thanks, Michael. So on the 6th of May earlier this month, the OECD released yet another public consultation for Pillar 1. And this time it was in relation to the regulated financial services exclusion for Amount A. Now, before we move into the details, let me first make a few sort of starting comments on who falls within the scope of Amount A under Pillar 1. Based on developments to date, it's been quite consistent that Amount A will be applied based on a threshold test, based on whether a multinational group is deriving more than 20 billion euros in revenue and has a profitability of more than 10%. So this is known as like the threshold test. However, when Pillar 1 was first sort of introduced in the blueprint, there was also an additional activity test. At that time, it was contemplated that Pillar 1 would only impact multinational groups that engaged in quote-unquote automated digital services or consumer-facing businesses. And this was widely viewed to be targeting certain US tech multinationals. Now, that activity test has since been removed, and you don't find it being discussed anymore, say in the subsequent statements by the 138 or so countries. Now, I think what this means is that when a multinational group crosses the revenue threshold and the profitability threshold, in the absence of the activity test, a lot of groups are going to start looking at the regulated financial services exclusion as perhaps one of the key lifelines to ensure that they do not fall within the scope of Pillar 1. And that really puts the design and the scope of these exclusions in focus. So let me go to the next slide. And what I'm going to do now is just spend a few minutes talking about this draft document that sets out, what currently is contemplated to constitute the regulated financial services exclusion. I'm going to do it backwards. The document actually goes through the compliance process first, and then the scope of institutions that are excluded. I'm going to do it backwards. I think that sort of flows better. And let me start first by also, while we have this list of financial institutions on the screen, let me also start by talking about the blueprint, because the blueprint really explained the conceptual basis of why financial services were viewed to be legitimately excluded from Pillar 1. The policy rationale was that when you look at Amount A's threshold test of revenue and profitability, these were not the most appropriate for financial services. So, for example, a 10% profitability threshold, this metric wouldn't really apply in the same way, say, for a bank as it would for a non-financial services multinational group. And that's because banks, in particular, report trading revenue net of trading costs and interest revenue net of interest expense. So these matrices worked well in most commercial circumstances, but when it came to financial services, the view was that they wouldn't apply in the same way, and therefore they were less appropriate for financial services. And another sort of conceptual policy thinking behind the concept of a carve-out for financial services was that where regulated financial services entities were already subject to regulatory capital requirements, this would help to align the location of profits with the market that was being served. And in other words, there was a lower risk that you could engage, or such entities could engage in profit shifting. So with sort of that as the underlying foundational thinking, let us explore the scope of excluded financial services entities under the draft document. So as you can see from the screen, there are 7 types of regulated financial services in the draft document. They are, and I'm going to just read through them. It's a depository institution, a mortgage institution, an investment institution, an insurance institution, an asset manager, a mixed financial institution. That basically refers to a financial institution that sort of engages in multiple activities per the list above. Say, for example, you engage in both depository and investment activities. And lastly, you have an RFI service entity. That's basically an entity that's limited to servicing other regulated financial institutions. And this is a very, very limited type of entity. The consultation documents have been clear on this, that it's not intended to be a catch-all category, but rather a very narrow category which only covers sort of captive service entities that performs functions for other group regulated financial institutions. So, for instance, if you have a captive company that only performs administrative or payroll functions for other regulated financial institutions, say a depository institution, and in particular, the consultation document states clearly that this will not cover fintech or payment processing services. In other words, activities that derive third-party revenue. So I think that's an important exclusion. And prior to the release of this draft document, there was some anticipation among some multinationals that hopefully the regulated financial services carve-out would include, fintech or payment processing kind of functions. But I think the current draft clearly indicates that it would not. Something that is also important to note is that for all of these categories, they generally contain 3 common elements, and all of which must be satisfied to qualify within that category of a regulated financial service, regulated financial service entity or institution. And that's number 1, a licensing requirement. Number 2, a regulatory capital requirement. And number 3, an activities requirement. Now, one point to note is that this list of regulated financial institutions is not a fixed list. And the consultation also states that some members actually take the view that reinsurance and asset management should not qualify for the exclusion. We are aware that there has been a lot of industry pushback. So in the consultation comments from various firms, there has been a large, quite powerful call for reinsurance and asset management to remain on the list. Let me move on to the next slide. Now, assuming that your multinational group falls within the list, how do you then proceed with compliance? Now, the public consultation document provides the 7 steps that we have reproduced on this slide. I think, and it's quite interesting how they've done it, right? Firstly, what you would do is that you would just apply the revenue and profitability threshold as usual to test on a prima facie basis whether you fall within the scope of amount A under Pillar 1. Now, assuming you do, what you do then is to carve out profits or revenues from regulated financial services activities, and then you retest whether the group falls within the euro 20 billion threshold. And you do the same thing for profitability. You carve out profits from regulated financial services activities, and then you retest the profit margin based on the remaining in-scope profits. And you do this until, and when you carve out all these, excluded revenue and profits, you then consider whether you are in scope, and if so, you proceed down with steps 4 to 7. Now, a few comments on this process. Now, you recall that the exclusion, or rather qualifying as a regulated financial institution, relies on 3 elements. There was a licensing element, there was a regulatory capital requirement, and there's an activities requirement. Now, in terms of, because what the compliance process here, it contemplates an entity by entity analysis. So you will go through down your list of entities. Say if you have 700 entities in the group, you go through one by one, and you will then apply these 3 tests to consider whether that entity is excluded or not. And I think one key point here is that because it's an entity by entity analysis, when it comes to the activities requirement, which basically requires you to look into the activities of that entity and also consider in some circumstances whether the profits derived by the entity sufficiently derived from the contemplated activity, say a deposit institution, how much money is being derived from that depository activity. When you start to do that kind of analysis on an entity by entity approach, multiplied by 700 entities in your group, that can start to become very cumbersome. So I think the compliance burden in this process is in focus, and the OECD's documents themselves do admit that they need to think about the compliance process more and think of ways to streamline the compliance process. So I think this is going to be a moving target, but I think now we're starting to see with greater clarity who's going to fall within Amount A and who's not going to fall within Amount A in the context of financial services. Over to you, Michael.
Thanks, Hung. Appreciate it. Before looking at specific digital tax-related developments, we thought it might be helpful just to take a step back and look at some of the broader technology developments and trends. And Matt, can I bring you in here just to kind of give us that sort of brief overview?
Sure. Thanks, Michael. So hi, everyone. So focusing on technology and trends, I think key observations that we have from practice are that the roles of market participants are changing. There's blurring of industry lines, and that not only increases competition, but due to the development of challenger operating models, that impacts both revenue generation opportunities and more fundamentally potential sources of revenue. Now, in addition to that, disintermediation and the growth of platform ecosystems also creates new categories of market participants and further reduces barriers to entry. Now, that's leading to a greater focus on customer personalization and an increasing focus on user experience as a point of differentiation. So such changes are materially impacting the relative importance of business functions across sectors, and financial services is no exception. Now, one key impact that we see is that value transfer is becoming a more embedded function, and such dynamics require stakeholders to adapt, which is prompting active changes to financial services products and functions. Now, a key factor for financial institutions in the past has been data, as financial institutions have been a de facto aggregator of material customer data on a real-time basis through their traditional operations for a long time, which puts them in a strong incumbent position and may potentially enable them to act as ecosystem orchestrators going forward. Now, the next slide covers a handful of different trends and the tax issues of greatest relevance in each case. I won't go over each development individually, and we'll leave you to take a look at the slides and the content in greater detail in your own time. But we'll highlight that there's a common theme across trends on this slide and the next, and being that whilst technological developments aren't new, the pace at which things have been moving has markedly increased, including because of COVID prompting a greater impetus for digitization. Now, a key issue for incumbent stakeholders has been legacy systems concerns and the need for incremental returns to be high. But now that the market is moving much more rapidly toward deployment of new tech, there's becoming an increasingly large gap between tech-enabled and non-tech-enabled products and services. And my view is that over time, that will push the importance of the need for incremental returns down. And over time, digitization will become more business critical. So from a tax and supply chain structuring perspective, it's important to keep in mind that it's increasingly necessary for the tax function to have a seat at the table and to input into new technological deployments from the design phase. And I think the key takeaway with respect to all of this is it begs the question about what needs to be done internally for that to happen and for tax to be seen as a key contributor to those types of discussions. So with that, Michael, I'll pass back to you.
Yeah, thanks, Matt. Appreciate it. Terence, maybe sort of to bring you into the conversation, I mean, one of the developments, trends that Matt just noted is the emergence of crypto and tokens as a new asset class. The OECD's kind of been focused on that in terms of, the changes needed to the Common Reporting Standard or CRS framework to sort of take account of the issues relating to those assets. So, Terence, do you mind sort of just walking us through, the work that the OECD has been doing, but more importantly, their proposals and how, for instance, they would look to be look to have sort of CRS cover crypto assets from a reporting perspective. Terence?
Thanks, Michael. You're certainly right. The OECD has been busy. They've been undertaking a comprehensive review, as they call it, of the CRS in really consultation with participating countries like, all the countries in this particular region, to consider changes to make the exchange of information more useful and effective for tax authorities, now that they've actually been exchanging information for quite a number of years now. So it's really time to re-look at the information that they have received and exchange. The OECD has also been working through a number of items relating to the reporting of digital financial products. And you'll see more and more of this kind of theme on digital financial products and crypto coming down the line. So on the 22nd of March this year, the OECD published a public consultation document which includes proposed amendments to the CRS and the introduction of a new crypto asset reporting framework, or CARF, another acronym, CARF. So the proposed amendments are subject to further consultation, of course, and so the actual amendments may actually differ to those proposed. However, I think it's worthwhile for us to kind of step through what the changes are, even though, it may well look different when it's finally finalized. The proposed amendments to CRS due diligence procedures and reporting requirements are intended to improve reportable information and reduce the burden on financial institutions. So the changes to the CRS proposed include, number one, expansion of the reporting requirements to include the following: the role of controlling persons for an entity account. And in the case of an equity interest held in an investment entity, the role by virtue of which the reportable person is an equity interest holder, right? So clarification and expansion in that regard. Whether the account is a pre-existing or new account, meaning you need to be able to report pre-existing versus new account separately, and whether a valid self-certification has been obtained. Again, more information to go into your report. Whether the account is a joint account, as well as the number of joint account holders. The type of financial accounts. Right now, you're not required to disclose what type of financial accounts it is, but going forward, you will be under the proposal. For example, whether it's a depository, custodial, equity or debt interest, or cash value insurance contract. Now, the second change is really to create exceptional due diligence procedures for cases where valid self-certification was not obtained. This is in order to ensure reporting with respect to such account is correct. So as you know, currently the CRS does not foresee any procedures to be applied in exceptional cases where reporting FIs did not comply with the requirement to obtain a valid self-certification form, because you're not supposed. These rules are not required because you're not supposed to open an account without a valid form. But of course, as we know, in practice, it happens, right? So to address these situations, it is proposed to require financial institutions to temporarily determine the residence of the account holders or controlling persons on the basis of the due diligence procedures for pre-existing accounts. Now, the third change that is proposed is a qualification of certain capital contributions as excluded accounts, again, expanding the list of excluded accounts. The fourth change, expanding the scope of depository institution to include entities that are merely licensed to engage in certain banking activities but not actually carrying on those activities. Number five, clarifying the meaning of customer and business in the context of investment entities. For example, it is proposed to explicitly confirm in the commentary that investors of funds can be considered customers. Number six, reporting with respect to dual resident account holders. It is proposed to revise the commentary to remove the references to tiebreaker rules and to state that in dual residence or multi-resident scenarios, all countries of tax residency should be self-certified by the account holder, and the account holder should be treated as tax resident in all identified jurisdictions. Number seven, reflecting government verification services, or GVS, within the CRS due diligence procedures. It is proposed to allow financial institutions to rely on a GVS procedure to document an account holder or controlling person as part of CRS due diligence. Number 8, exclusion of look-through requirements with regards to controlling persons of publicly traded entities. Makes sense, right? Number 9, integration within the commentary to the CRS of the OECD's guidance on citizenship by investment and residency by investment schemes. Obviously, these are not part of the rules now, but it's really part of the overarching commentary by the OECD as part of the FAQ. And transitional measures, obviously, not everything can come in on day one, so there will be certain transitional rules built in order to allow for adequate time to comply with these new requirements, including a 2-year transition period for reporting the role of controlling person of an entity. Well, as well as these proposed amendments, the consultation document also includes a number of questions for further consultation, which is listed in the green table at the bottom of the slide. Now, the consultation document also includes proposals to expand the scope of the CRS to include digital money products and central bank digital currencies, as well as indirect investments into crypto assets. The proposed changes to the CRS for digital money include, the first one is introduction of a new term, specified electronic money product, to cover digital representations of a single fiat currency. Introduction of a new term, central bank digital currency, right, covering any official currency of a jurisdiction issued in digital form by a central bank. It also amends the depository institution definition to include e-money providers. It also amends depository account definition to include accounts that hold specified electronic money products and central bank digital currencies. It will also introduce 2 new categories of excluded accounts. The first being specified electronic money products, where the value does not exceed a certain threshold. And number 2, specified electronic money products that are created solely to facilitate the funds transfer pursuant to instructions of a customer that cannot be used to store value. So again, further excluded accounts are to cover some of these digital money products. It will also modify the definition of non-reporting financial institution for a central bank. Now, the amendments to CRS have also been proposed to include derivatives referencing crypto assets in the definition of financial asset. Again, expanding the word financial, expanding the definition of financial asset, and expansion of the definition of investment entity to include activities of investing in crypto asset. So it's really expansion of both the definition of financial assets and also the definition of investment entity. And obviously, because there are 2 regimes, the CRS and CARF, there are proposed amendments to address duplicate reporting. For example, the proposed amendments provide that where there is a disposal of a financial asset, is reported, and that's reported under CARF, then no gross proceeds reporting is required under the CRS, which again makes sense. Next slide, please. Yeah, so CARF, Crypto Asset Reporting Framework, a new regime. So a large part of the consultation document relates to this particular new regime. So this is being introduced as the crypto asset is viewed, obviously, as we all know, as a significant risk to the gains made in the global tax transparency. I think that is, so it's not covered by CRS at the moment because products and intermediaries may not fall within the scope of CRS and thus may not be subject to reporting, and so crypto assets may be used technically to evade tax obligations. So the CARF is based on the CRS. It's not CRS, but it is based on the CRS. And the draft includes rules and commentary and will be based on bilateral and multilateral exchange arrangements to exchange information for crypto asset users based on their country of tax residence. Again, very similar to CRS. Without going into all the details, the CARF has 4 main elements. The first element is the definition of crypto asset. So, which is, essentially defined to include similar technology to allow the CARF to apply to new technologies yet to be developed, so to future-proof the definition of crypto asset. The definition aligns with the scope of FATF recommendations so that intermediaries can extend their AML and KYC obligations to CARF. The second element, the intermediary subject to data collection and reporting, in other words, who is required to report. That's all covered within the regime. So these are those that provide services to effect transactions in crypto assets for or on behalf of customers, and includes exchanges, brokers, dealers, operators of crypto asset ATMs. The third element is the transactions subject to reporting, right? And the information to report, such as the value and the gross proceeds, that's all listed within the regime as well. And the last element covered by this particular regime are the due diligence rules to identify crypto asset users and their jurisdiction or tax residence, which are based on CRS. So, CRS, as you know, have rules around self-certification collection. So they are going to piggyback off the CRS rules in order to introduce these new due diligence requirements on CAF. Well, all we can say at this stage is that it's still quite early days. Watch this space. I may hand it back to you, Michael.
Thanks, Terence. It was actually interesting when you mentioned that some of the changes will be via changes to the commentary. If you look at Singapore, our regulation basically says the regulation should be read in light of the commentary. So once the commentary changes, for instance, that would essentially kind of take effect in Singapore and have and sort of essentially be, have a force that sort of follows from being referenced in the regulation. So that's kind of interesting. Thanks, Terence. Matt, last week, the OECD actually held a public consultation meeting on these proposed changes, on the changes that Terence has just outlined. Can you share some of the takeaways from that meeting?
Yeah, sure. So it was actually quite an interesting meeting. I think with respect to the CRS proposals concerning extensions to the scope of reportable information, members of the OECD's Working Party 10, which is the group that's leading the production of the proposals, said that financial institutions should already have the relevant information available. Now, industry representatives acknowledged that that might be the case, but highlighted that such information will in many cases not have been captured in such way as for it to be readily retrievable or usable, and that consequently process and systems changes would likely be necessary to enable FIs to discharge the additional reporting. Now, with respect to the CAF, the discussion instead principally focused on the scope of the proposals. The working group, and particularly the UK representative of the group, advocated for a broad scope, whereas industry stakeholders explained why they thought such a broad scope might not be realistic, including due to technological limitations and because traditional financial services concepts often don't easily translate into the digital assets context. Now, interestingly, there was some discussion based on which we might speculate about the potential implementation date. And I should highlight that this is pure speculation at this point. The OECD working group said that it would consider the consultation responses received over this summer and feedback in Q4 of this year. Now, depending on the state of the proposals at that time, and I guess also the political dynamics, a finalised proposal could perhaps therefore be adopted in 2023, perhaps at the earliest. Industry representatives suggested that at least 2 years would then be needed between publication of final rules and actual implementation to provide sufficient time to make necessary business and systems changes. Interestingly, a representative of the European Commission suggested that the minimum necessary timing could be closer to 3 years. So if we're talking about an effective date 2 to 3 years from next year, we could perhaps speculate an overall effective date in around 2025 to 2026. That said, given impacts of the CRS proposals are narrower than the CAF, it's not beyond the realm of possibility that implementation might precede implementation of the CAF.
Thanks, Matt. I think the OECD has been sort of separately undertaking work, specifically surveys around the taxation of crypto and digital assets as jurisdictions start to tackle those issues. I mean, can you sort of touch on the status of that work generally, but more specifically, what are some of the digital tax, the digital asset tax developments that we're starting to see in the region, just in terms of as an example of how the environment is evolving?
Sure. So there have actually been quite a lot of interesting developments. I think if we firstly look to where we were a year or two ago, the tax implications of digital assets were still materially unclear. But if we take a look at where things stand today, I think it's fair to say that regional governments and tax authorities are more aware of the tax challenges. Many have published guidance, and tax treatments from jurisdiction to jurisdiction are perhaps becoming a bit clearer. That's perhaps partly due to relevant businesses having now been through one or more rounds of annual filings, which I think has perhaps forced a review of positions. Secondly, some jurisdictions clearly remain sceptical of cryptocurrency-related activities and have proposed using taxation as a way to try and curb what may be seen as speculation. So if we look at India, for example, India implemented specific measures to tax cryptocurrency sales proceeds at the highest tax rate and without allowance for cost basis. Thailand had proposed what the market had considered a penal 15% capital gains tax, but quickly cancelled the proposed measure shortly after its announcement due to pushback from traders, and then subsequently announced friendlier taxation. I think it's fair to say that the prevailing approach across the region appears to be subject to general income tax principles, and to apply them on a facts and circumstances type basis. So looking at identified principles, case law, working from the ground level upward in order to identify how the rules should apply based on the specific facts of how a particular blockchain protocol functions and what cryptocurrencies do within the ecosystem that is created. I think there are exceptions to that generalized approach. So India, Thailand, Indonesia, for example. There's some detail at a high level of each of those jurisdictions' approaches on the slide. I think more generally, Michael, talking about the Paris meeting last week, the OECD commented that in addition to Working Party 10, which is the working party focused on the tax reporting proposals, there is a second working party, Working Party 2, which incidentally was the group behind publication of the OECD's cryptocurrency taxation paper about 2 years ago, that is engaging in further work concerning the technical challenges arising in the context of cryptocurrencies. Now, the past paper identified and reported on prevailing tax treatments globally, and it perhaps is hopeful that further OECD work in the space will further that discussion and help lead to greater alignment in positions between jurisdictions over time in a way that helps address potential double taxation concerns.
Okay, thanks, Matt. Sen, maybe to bring you in here, the OECD in its earlier work had sort of focused on the taxation of electronic and remote services. So can I get you to give us an update on where the implementation of that initiative stands in Asia Pacific?
Sure. Thanks, Michael. So what you see on the screen here is a table pretty much summarizing all of the jurisdictions that have implemented electronic services rules and remote services rules over the past decade. And we're seeing a number of other countries sort of announce the implementation of such rules in the near future as well. So all of this is sort of culminated from that initial, as Michael mentioned, that initial guidelines that were released by the OECD. And at a broad level, I think what we've seen across the region, the adoption of these rules have been fairly consistent with the guidelines that the OECD has outlined. Essentially, that the tax should be applied on any electronic/remote services that are delivered from one jurisdiction to another, where that customer sort of consumes that service from that location, from their home location, rather than from the service provider's location. And how the OECD sort of proposed that tax would be applied is where tax is collected on a business-to-business transaction by a reverse charge. And if it's a business-to-consumer transaction, that would be addressed by the foreign entity undertaking a local registration and collecting that tax. So whilst the models, in the region have generally followed that, and you'll notice that there are some exceptions, especially those countries that are taxing B2B services as well as B2C under a local registration. There have been some themes and some observations that we can make from what's happened over the past sort of 10 years. So whilst the principles have been the same, what we've observed is that tax authorities have taken different interpretations around what is in scope and what constitutes, in particular, what constitutes an electronic service, and within that, what levels of automation or human intervention is required to sort of demonstrate that something is an electronic or digital service to be caught under the tax. Now, although, again, we've sort of made that distinction between B2B and B2C, what we've observed from the law that's been implemented, B2C, or consumer in that B2C, is broadly defined and includes entities that are not VAT or GST registered in that home jurisdiction. Further, you'll note from the table that there are exemptions for financial services in most of these jurisdictions, as sort of broad-based. So even Malaysia, which has no broad-based financial services exemption, does have one for local banks. Nevertheless, even in all of these jurisdictions that do have the exemption, that exemption doesn't cover all forms of financial services. And so there's a host of financial services activities that can still be taxable. Now, a further, more recent development in this space is that the OECD has now come out with a toolkit specifically to guide Asia-Pac tax authorities around the implementation of these rules, as well as rules governing the low-value goods, so the import of low-value goods. The toolkit, amongst other things, emphasizes the following concepts. So, for B2C, taxation should occur where consumption occurs, and this is based on the customer location. So you're really looking at things like the customer address, IP address, telephone numbers, that kind of thing, to determine where that customer is located. The only exception to what they consider remote services are services which are consumed on the spot. These are effectively consumed in the location where the service provider is. I think what we can take away from the OECD toolkit is that it reinforces the principles that services or intangibles that are supplied online or electronically that do not require the customer to be physically located where the service performed ought to be taxed under either a B2B reverse charge or under a foreign vendor registration model where it's B2C. Importantly, I think in the toolkit, what we've seen is that the OECD have used the term remote, meaning that even in their mind, they see this as beyond the standard electronic services such as subscription, online streaming, purchase of apps, and they do see that this can be applied more broadly to any forms of remote services that are provided by a foreign entity to a local customer. And I think what we're seeing in terms of how tax authorities in our jurisdictions are interpreting and applying these rules seem to be very consistent with that, where we're seeing a much more broader application than just purely your standard electronic and digital services. Now, we move on to the next slide. So to sort of build on my earlier point, so whilst I think tax authorities and treasuries may be taking a more expanded view, I do want to make it clear that there's no evidence that we've seen where they're seeking to tax traditional financial services. So, we're not going to see VAT or GST imposed on deposits or lending under these provisions. However, the area of concern really is really around what falls outside of the normal exemptions, things like fees, where fees and commission income are earned, and in particular, the shift in terminology and focus from digital transactions to remote implies that things like intermediary and advisory services can be brought into the net. And as I alluded to earlier, there are already numerous examples of that in the region. So if you look at say New Zealand and Australia, they've adopted a much wider definition of what can be caught under their indirect tax, and it can include a lot of non-digital services such as consulting and accounting. We've heard recently that a lot of us are aware that Singapore is also expanding its overseas vendor registration system as well from 1 January 2023 to include non-digital services. If I focus on a couple of other jurisdictions, if you look at Indonesia and Malaysia, where the rules don't even mention remote services and seem to be focused purely on digital services, but what we've seen in practice is that the authorities are seeking to impose tax on a whole range of financial services type activities, whether that's payment networks, payment services, e-wallets, P2P lending. So a lot of that fintech sort of sector we're seeing get caught under the net. I'll talk a bit more in more detail about what we're seeing in Singapore and Indonesia because they're the more recent ones. But at a sort of broad level, I think for the participants, industry participants, and for those in the audience, I think it's very important to sort of continue to monitor the evolution of these rules, and and be prepared to sort of assess on a jurisdiction by jurisdiction basis around the potential impact and whether a registration requirement would arise for you in a particular jurisdiction. Again, to stress that point that what we're seeing is in practice, things can vary from jurisdiction to jurisdiction, even though the law may seem the same. If we move on to the next slide, I'll touch a bit on Indonesia. So, as I mentioned, so Indonesia recently introduced new guidelines on the VAT treatment of fintech services. I think, in a nutshell, any services where the consideration is in the form of a fee or a commission appears to attract VAT. So if we look at P2P lending, investment management, market support, where there's a distinct fee involved there, the view of the authorities in such scenarios, they're expecting VAT to be collected, and so that reinforces that point that I made earlier, where although we may think traditional electronic services like online services and subscriptions might be what caught, in reality, it's much broader than that. If we move to the next slide on Singapore, as I said, it's expanding its regime to include all forms of remote services. What we're seeing in terms of the model, it's really consistent with what the OECD has outlined in its own toolkit. It uses very similar terminology, remote services and on-the-spot services. So at a high level, any forms of non-digital services that do not fall within the current definition of digital services, but are consumed regardless of physical location, would be caught under these new rules. So as a consequence, the overseas vendor or registered party no longer needs to differentiate between digital and non-digital services and would need to apply GST on both. The exclusion really is for, as I mentioned earlier, on-the-spot services, and those things are where services are physically consumed. So the example that they give is hairdressing, but you can sort of extend that to any sort of service where you have to be physically there, where the service provider is to consume that, and all forms of other sort of remote services would be caught under this. So, in terms of some of the other examples that have given, so education, consultancy, and advisory. So it's really now moving, as I mentioned earlier, much away from that initial thought of very much that sort of that digital services and app providers, the Netflix, the Disney's. It's moved beyond that to really touch a lot of other industries. If we move on to the next slide, I think I might hand it back to Michael. I think we've got a polling question.
Okay. Yeah, thanks, Sen. And you're right, we do have a polling question. And it's a topic that we're going to get to just after the polling question. But before we do that, we're interested to understand how prepared your business is for the adoption of e-invoicing and real-time reporting measures in Asia. The responses are early planning, organization-wide strategy in place, not prepared or not yet a priority issue, don't know, not applicable. So if we could get your response to that, that would be great. And Sen, just while we're waiting for those responses to come through, what's your sense in terms of the focus on this area?
I think what we're seeing, in the market is a real range in terms of how where businesses are in terms of this journey. So, we're still seeing some clients who are sort of at the stage where they're still trying to really understand the requirements in each local jurisdiction where they're operating in. Whilst others have sort of developed a more comprehensive strategy and have included this as part of a wider tax and technology transformation. So they're focusing on things like internal processes, but also looking at, in particular jurisdictions where they can enhance internal systems, or they have to then look at adopting third-party solutions or working with third-party vendors. I think these differences, will remain as long as these requirements are not mandated. But and I'll touch on this later. But as we move towards that, I think we'll see a lot more clients pushing this space.
Thanks, Sen. And the results are just up on the screen now. So almost 30% was sort of at an early planning stage. Almost 20%, 18.5% organization-wide strategy, 10% not prepared, 8% not yet a priority issue, and not applicable for a number of folk. So Sen, with that with those survey results in mind, could you walk us through sort of these requirements and sort of share your thoughts?
Sure. Thanks, Michael. So we just jumped to the next slide. So advancements, in technology and data management, really sort of led tax authorities to sort of introduce digital compliance measures such as electronic invoicing and electronic reporting, or real-time reporting as it's known in some jurisdictions. The real aim behind this is to improve tax collections, reduce tax gap, and just give tax authorities and treasuries much greater visibility over a taxpayer's operations. And, that should help in terms of audits, but also in enforcement and broader level enforcement. Now, what we expect is that by 2030, almost every country would have implemented some form of electronic reporting. In Asia, we've already seen a number of countries, either announce or implementing invoicing or electronic reporting measures. There are a number of jurisdictions which are sort of adopted the PEPL standards, like Singapore. Australia's announced that as well. It looks as if Malaysia is going that way, and equally, then there are a number of jurisdictions that have developed their own requirements and their own systems, such as India and China, and we're seeing similar indications for, say, Philippines, and also you've got Indonesia as well. So, whilst there's slightly different approaches there, I think what's been fairly consistent is that the countries in our region have sort of adopted what they call a clearance model, which requires businesses to sort of clear or authorize invoices through tax authority systems for the invoices to be treated as valid and compliant invoices. So, whilst e-invoicing and real-time reporting requirements, they're not mandatory for all types of transactions. So for many jurisdictions, they may be just limited to B2G, business-to-government transactions, or business-to-business transactions, as part of the initial pilots. But what we're seeing, the eventual evolution of these rules is that it's likely to be at least mandatory for all B2B transactions in the near future. So what does that actually mean for the industry, and what does that mean for taxpayers? So if we jump to the next slide, how do you actually approach this? I think one of the key takeaways is that given that Asia, we don't really have a homogeneous system. We've got countries across the region sort of operating fairly independently in terms of the way they're doing this. I don't think you can adopt a one-size-fits-all solution covering all requirements for all regions. It's important that you sort of have an overarching strategy, so develop that strategy and determine an appropriate response model. in our mind, or in my mind anyway, an appropriate response should really look at it from a number of points. One, you've really got to understand and assess the local requirements. You have that broad strategy, but understand and assess the local requirements specific to each jurisdiction you're operating in. Undertake an impact assessment or fit gap analysis around your existing systems and processes. So what do you actually need to do in order to get ready? And then using that, that study or that impact study that you've done to develop a roadmap and a framework. And that should also include, whether you are going to do enhancements internally in order to be able to sort of generate the right data or the right invoicing, to link up with the taxpayer system, or whether you need to acquire a third-party solution to sort of get you that way, get you to where you need to go. And then once you've sort of developed that roadmap and framework, it's really going through that implementation phase, but then having a continuous process improvement phase where once this is not going to be a set and forget. So once it's implemented, we anticipate that there's going to be regulatory changes, additional requirements, and things that will necessitate you having to continue to sort of monitor this. One of the things that we see as a positive or a benefit arising from this is that given that this is a regulatory requirement, it impacts the entire business, and there's a significant tax element to it. There is that opportunity to use this transition to e-invoicing, real-time reporting as a stepping point to really get a wider tax transformation exercise happening. And so, we are seeing some clients sort of go that way in terms of embed this as part of a larger project. And many of our clients, I think, are struggling with manual processes and other sort of systems and reporting challenges. And I think using this transition to sort of rectify wider tax reporting issues, it presents a good opportunity. So with that, I'm going to hand it back to Michael.
Thanks, and thanks also to Han, Matt, and Terence. This brings us to the end of our discussion today, but we do have a few minutes to take some of the questions that you posed. And Matt, maybe if I could bring you in here. The first question was, is there any update on the US crypto tax reporting rules that's supposed to be effective 1 January 2023?
Sure, thanks. So I guess we're not aware of any specific further updates as regards to US timing at the moment, but it's correct that it's been suggested that they would apply from the beginning of 2023. Hopefully further guidance will be available soon, but interestingly, at the OECD meeting last week, it was suggested that the OECD and the US approaches would ultimately be expected to be similar in terms of their scope and how they would apply. Now, given the OECD proposals have highlighted that there's quite a lot to consider, I think that means that it's perhaps going to be interesting to see if the 2023 date is realistic or whether the US might push that back slightly. So I guess what the high-level answer is watch this space. But it's interesting that the authorities expect everything to be consistent broadly, at least from a conceptual perspective.
And Matt, just while you're up, one further quick question. I mean, the tax treatment of crypto in Hong Kong or digital assets in Hong Kong, just very quickly.
Yeah, it's just very high level. It's perhaps not too dissimilar to the approach that's taken in Singapore, which is logged on the one slide earlier in the deck. The IRD in Hong Kong has issued a guidance note referred to as DIPN 39, which it might be worth looking at if you're interested in the specific rules. High level, it basically explains the facts and circumstances type approach. Obviously, anything on capital account not taxable. Income is prima facie taxable, subject to the source requirements, and obviously, when you're comparing with Singapore, you can discount indirect taxation.
Thanks, Matt. And Han, just the last question we have time for today. You talked about Pillar 1. Obviously, there's been announcements around the timing of Pillar 1 and Pillar 2. And Pillar 2 might proceed before Pillar 1. I mean, any thoughts, any points to add just in terms of how this will all impact multinationals who are in scope?
Yeah, thanks, Michael. So I think it's very interesting that if you look at the EU developments, we are seeing we're seeing the likelihood that Pillar 2 will be implemented before Pillar 1. If you think about how it all started and how the momentum for the BEPS 2.0 project came to be, it was really the US that wanted to increase their minimum rate under GILTI, and therefore pushing that project forward. And I think the US accepted that in order for Pillar 2 to gain momentum, they needed to give Pillar 1. And I think there's an open question now among many commentators that if we do get Pillar 2 implemented before Pillar 1, would we even see Pillar 1 at the end of the day? And there are some commentators who are wondering or hinting that they will not be surprised if Pillar 1 eventually falls away, but that I think is a question of politics, and we will all hang tight to watch that space.
So lots of spaces to watch is the key takeaway from today's presentation, I think. But that, unfortunately, is all we have time for. Again, I'd like to thank Sen, Han, Matt, and Terence, as well as special thanks to all of you who are able to join us today. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you thought about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please feel free to share the webcast via the Share This icon or have them visit the Debriefs website. We will respond to all the questions submitted during the webcast within the next kind of week or two. Also, if you have any other questions or comments later, please feel free to reach out to me or to our speakers. We'd be more than happy to talk to you. And please don't forget to tune in our next scheduled webcast from the Corporate Income Tax series on 31 May, titled M&A and Carve-Out Strategy in Southeast Asia. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.
Hi, team.